Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding Internal Rate of Return, IRR, a guide for smarter investment decisions. Financial calculators. Devices like the Texas Instruments BA2 Plus are designed for IRR calculations. Input your cash flows, hit the IRR button, and you're done. It's that simple. Financial software. Platforms like QuickBooks, SAP, and Oracle streamline IRR calculations for businesses. These tools let you input cash flows and generate IRR instantly. They're ideal for handling complex projects with multiple variables. Online tools. Many free online calculators allow you to compute IRR with minimal effort. Just enter your cash flow data into a template, press calculate, and get results. Tools like these are perfect for quick, one-off calculations. Using these tools frees up time to focus on analyzing results rather than doing the math. They're efficient, accurate, and indispensable for modern finance. Excel function for IRR. Detail how to use the IRR function in Excel for quick computations. If you have Excel, you can calculate IRR without breaking a sweat. Excel's IRR function is one of the easiest and most reliable ways to find the internal rate of return. Here's how to use it. Prepare your data. List your cash flows in a single column. Start with the initial investment as a negative value, then enter all future cash flows as positive or negative numbers, depending on direction. Example: Year 0 to 10,000, Year 1 to 4,000, Year 2 to 4,000, Year 3 to 4,000. Enter the formula. In a blank cell, type equals IRR. Inside the parentheses, highlight or select the range of cash flow cells. Example: equals IRR, A1, A4. Press enter. Excel will instantly calculate the IRR. For the example above, Excel would return approximately 10%. Optional guess. If Excel struggles to calculate IRR, you can add an estimated rate as a second argument. For instance, equals IRR, A1, A4, 0.1. Excel's IRR function handles much of the heavy lifting, even for large projects. It's fast, accurate, and adjusts to changes in your data. For more advanced scenarios, try the XIRR function, which accounts for uneven cash flow dates. By using Excel, you can quickly calculate IRR while staying organized. It's perfect for both beginners and pros alike. Advantages of using IRR. When evaluating investments, the internal rate of return, IRR, is a powerful tool. It's widely used because it simplifies complex financial decisions. But what makes IRR so effective? Below, we'll explore 2 key benefits that set it apart. Simplicity of interpretation. IRR is straightforward and easy for stakeholders to grasp, even if they're not financial experts. Why? It boils the performance of a project down to a single percentage. This makes it incredibly user-friendly when presenting investment options. Clear communication. IRR answers a simple question: what return can I expect from this investment? Stakeholders don't need to decipher technical jargon or long reports to understand it. Universal comparison. Unlike metrics that require additional context, IRR allows direct comparisons between projects. If one project has an IRR of 12% and another 8%, the better option is clear at a glance. Accessible for decisions. Because it's intuitive, IRR helps non-financial leaders or smaller investors make informed choices. There's no need for advanced financial knowledge to see its value. Think of IRR as the common language of investment analysis. It helps keep discussions focused and decisions efficient. Time value of money consideration. One of IRR's most important strengths is that it accounts for the time value of money. Money today is worth more than the same amount in the future, and IRR recognizes this. Realistic assessment. IRR calculates returns based on when you'll actually receive cash flows. Investments that return money sooner will naturally show a higher IRR, reflecting their greater value. Better planning. Consider a project that generates equal profits over 5 years versus 10 years. IRR highlights the faster payback option, which helps manage cash flow and reduce risk. Aligned with priorities, businesses often set timelines for reaching financial goals. IRR aligns investments with these goals by prioritizing projects with quicker returns. In short, IRR translates future dollars into today's terms. This makes it easier to see which projects offer the most value, both now and in the future. When every dollar counts, having this perspective is critical. Limitations of IRR. While IRR can be a helpful tool, it's far from perfect. Like all financial metrics, it has its limits, and understanding these challenges is important. Below, we'll cover two key issues that often arise when using IRR. Multiple IRRs problem. One of the most confusing issues with IRR is the possibility of getting multiple values. This occurs with projects that have non-standard cash flows, such as alternating inflows and outflows. Here's why. IRR works by solving for the discount rate that sets the net present value, NPV, to zero. When cash flows flip between positive and negative over time, say, due to large reinvestments or unexpected expenses, there may be multiple rates that satisfy this equation. This results in more than one IRR, leaving investors scratching their heads. What does this mean for decision-making? A project might appear to have several potential rates of return, making it hard to pinpoint which one is correct. For instance, imagine a project starts with a $10,000 investment, negative cash flow. Year 1. Generates $15,000, positive cash flow. Year 2. Requires another $5,000 reinvestment, negative cash flow. In cases like this, you might find two IRRs, say, 10% and 30%. Which should you trust? Without additional context or tools, the situation can be misleading. Investors might make the wrong call or overestimate profitability. For projects with such irregular patterns, it's best to combine IRR with other methods, like net present value, NPV, or modified internal rate of return, MIRR, to get a clearer picture. Assumption of reinvestment rates. Another significant flaw with IRR is the assumption it makes about reinvestment rates. When calculating IRR, it's implied that future cash inflows will be reinvested at the same rate as the IRR itself. While this might seem logical, it's often unrealistic. Why? Reinvestment opportunities in the real world usually don't match the IRR of the project. For example, if IRR is 18%, the model assumes you can reinvest each dollar at the same 18% rate. But in reality, you might only find reinvestment options with a rate closer to 5% or 8%. These inflated assumptions can lead to distorted results. A high IRR might make a project look better than it is, especially if reinvestment opportunities are weaker. This is particularly risky for long-term investments where reinvestment plays a bigger role in total returns. To address this issue, many experts recommend using the modified internal rate of return, MIRR. MIR adjusts for a more realistic reinvestment rate, giving a clearer and more conservative estimate of profitability. It's like putting on a pair of glasses. It helps sharpen your focus and avoid overly optimistic expectations. Understanding these limitations ensures you won't blindly trust IRR. While it's a useful metric, remember it's only one piece of the puzzle when assessing investments. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.